You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose and welcome to Masters in Trading Live. At Masters in Trading Live, I get on here each day the market's open, go over the market, share some thoughts. Once in a while, we'll share our trade of the day. So what we're going to do, guys, is each day there's going to be a big lesson. So yesterday's big lesson that I want you to learn, you can go back and watch yesterday's live. When you're long stocks, your IRA, your long-term portfolio, that's long stocks, long tech stocks, long the big seven, you're short volatility. The VIX has gone straight up, right? The VIX is a 30-day measure of volatility. But when you're long stocks, it's like you're short volatility. Why? Because when the market goes higher, think of the market going up 1,000 points. It's all roses to the upside. There's no volatility to the upside. But when the market goes down, like it is right now, the VIX spikes. So yesterday's key lesson was your long stocks are short portfolio. The reason why I want you to learn how to trade is because traders help diversify your portfolio and can look at these times of volatility as opportunity and not as, oh shit, here we go again. Here's today's lesson. Today's lesson is going to be a trick that we used to do on the floor. I was a floor trader, from, say my age right now, from 97 to 2011. I was at the Mercantile Exchange. I traded on the options exchange down in Chicago. Here's a trick that we used to use. And we would use this trick when there's a reason for the market to move. Right now, there's a huge reason for the market to move, right? It's Liberation Day. It's the day where Trump is going to put the highest amount of tariffs we've had in the US since like the 40s. That's a reason for the market to move. But it's not only Liberation Day. This Friday is the first Friday of the month of April. The first Friday of every single month, non-farm payroll release. It's also the most volatile number of the month. So what we're going to do today, and you guys, this is going to be a ton of fun, is we're going to look for trades that are going to move because of tariffs and unemployment, but we're going to look for things that are expiring in 14 days. Because right now, with tariffs and uncertainty, I want you to watch this, and I want you to make a bunch of money in just 2 weeks. Let's see if we can get it done. Let's go to the screen and do our best efforts. I got the chat open as well for everybody in our chat. Starting with the screen share, and I'm going to start with the QQQs before I get into these trade ideas. QQQs, yesterday's high. We are right at yesterday's high. This is the low from a couple of weeks ago, a couple of days ago. We are going to see some resistance right here in the QQQs. John, Janet, thank you for joining. All right, let me get into the spreadsheet. So you guys want volatility? Here's 10 stocks that love tariff chaos. I'm going to start it here with a watch list, and I'm going to go through each one of these. So this may take a little bit, but that's okay. X, Ford, Amazon, Caterpillar, Nike, TSM, EU, Vail, TM, Fixie. EU is a Mexican ETF. Mexico. Implied volatility. Implied volatility is how much movement does the market expect? X has the highest volatility of the bunch. Fixie, China, has the lowest volatility. What about beta? Beta is systematic risk. When a name has a beta of 1.7, this name has systematic risk. X is going to move along with the market to some degree. Fixie is not. You can see it's got a very, very low beta. So let's go through these one by one. Again, I have the questions up. If you have questions up, we'll keep them up throughout. Sound fun? And what are we going to do? I'm going to pull up an option chain. I'm looking at the questions. I just have the questions up on a different screen so I can monitor my real estate here. We're getting there, guys. Just give me a sec. Okie doke. Okie doke. We're getting there. I want the setup nice. That's not right. Okay. You can tell we're live because this takes me a minute to do, but that's okay. It's part of being live, right? Okay, we are ready. So I'm going to use the charts that you guys have seen me use on Masters in Trading Live, and I'm going to go through each one of these names. Now, again, what we're looking for, and we'll go through them like this. I'm going to go through them backwards. So we're going to look in April. The first name that we're going to look at is TSM. Now, what we're looking for is we're looking for names that are in their expected move, maybe a little outside of their expected move. TSM closes within its expected move 80% of the time. So the ranges that I would look for TSM for the rest of the month is 154 to 200. Now, I don't know about you, but in the next 14 days, that is a ton of movement. Why is TSM going to move that much? To me, within 14 days, I don't really think TSM gets out of this range. Because of that, there's not going to be a trade for us. Amazon, 194, the expected move up to 213, 176. Expensive stock. I think we could do better. We're going to go through each one of these guys. Don't worry, we will definitely find some action here. This is always interesting to me. Look at Caterpillar, the same high the last three days in a row. I would think Caterpillar is going to trade higher. Caterpillar wants to trade higher with lower highs, the same exact high. Let's look at the options and see if we can find any value in Caterpillar. Again, the exercise that we're doing is how can we make money in the next 15 days in this April expiration? Now, April expiration, because Caterpillar is a $300 stock, it's really expensive. If we wanted to play the upside, we could buy these for $3.15. If I bought a one lot, that's a $315 investment. The only way I make money is if Caterpillar gets over 345. Actually, 348 because they pay $3 for these in 15 days. Very expensive. Does that make sense, guys? Why I think that's so expensive? Like, why do I want to risk $650 for this stock to get above 345 in 15 days? It's just too much. I don't want to do it. Does that make sense, guys, of why this is too expensive? I have the chat up. Hopefully it does. Yeah, it's just too much. Okay, we're going to find some great trades, but it's not going to be a $650 cross your finger and hope. Fixie. Yeah, too expensive. We're going to find better, guys. And part of finding trades is not only finding trades, you have to find trades that work for you. It's going to Fixie. Now, we know Asia is flying around. Now, for those who follow me, sometimes I make up my own terms. And one of the terms that I say often is that a name like Fixie is gappy. Gappy. Why is it gappy? Because China is open a different time than us, right? So when the Fixie opens during normal hours, oftentimes you'll get a very, very big jump. Now, most often, when you find these names that jump around, the options are very, very expensive. But Fixie is a little bit different. Fixie, the options aren't that crazy expensive. The expected move between 33 and 40. I want to show you one more example of a name that's got really great options liquidity, but it's gappy. There's another name that we trade in our Discord. It's Turkey. It's a Turkey ETF. Again, look at the gaps. Look at the gaps. Why is it gappy? Because Turkey is on the different side of the world than the US, but there's still good options liquidity. So Fixie, good options liquidity. It's gappy. Now let's go look at the options. Again, I want to be in 15 days because this exercise is how can we make some tariff money off these 15 days? Now, these are kind of trades that I like, guys. Now, remember, what did we just look at? Was it Caterpillar? It was $600 to do a one lot. We don't need to do that. Forget that. What about, here's a trade, Fixie. 36s and 35s. Buying for 70 cents and buying for 60 cents. So you're buying the 36 calls for 70 cents. At the same time, we're going to buy the 35 puts. And we can do that, let's say, for 60 cents. Now, how that trade works and why I prefer a trade like this is because for the next 14 days, I'm going to pull this up. I want you guys to ask questions about this. If there's any questions at all, I'm going to explain the exact Fixie trade. I got the questions up. So Fixie, here's what we're looking at. This is also, guys, a really, really good think the paper trade, especially if you're not comfortable with options. But I'm going to walk you through this entire trade, no matter how long it takes. So here's what it is. 35 puts would be right here, right? 35 puts. 36 calls would be right here. Now, if you do this trade that I'm sharing, that I'm suggesting, the risk is $1.30 because the calls, 36 calls for 70 cents, the 36 puts for 60 cents. It's $1.30 of risk. And think of it like you're long 100 shares from 36 and you're short 100 shares from 35. That's what the trade is. But what I want to show you too is 14 days. Do you think that we can break out of this little itty bitty range in 14 days? Are you willing to bet $130 per one lot that we could potentially do that? That seems like a really freaking good trade. Michael, yeah. So great question. Michael says, can we do a strangle when we have high volatility and still be profitable? Heck yes. Why? Because we have a catalyst for movement. Not only that, go away, wrong chart. Go away, wrong chart. Okay. I got to find the right chart because I got not only that to add. Because my not only that to add is that Fixie, FXI, and I'm going to pull up. Actually, I have it on the slide. Better yet. Fixie. Fixie. I'm going to get tired drawing so many circles. Now, X. Here you might get in a little bit of trouble, right? Because you need some really gnarly gnarly move to cover that implied vol. But implied vol of 30? Ooh, that's a really good trade. So the trade, as we just shared, in Fixie, 36 calls, 35 puts. I hope we can make some money with that trade in the next 14 days. Michael, my pleasure. Does anybody else have any questions about that trade, we're going to move on. We're going to keep going through the rest of these names. But does anybody have any questions about that specific trade? No, good. Awesome. Awesome. Okay, let's get back to it. Let's get back to it. So far, out of the names that we think are really going to move post tariffs along with NFP on Friday, guys, remember, non-farm payroll is Friday. We are going to move. Ford's another one, guys. Look at the range. 8 to 11. Can Ford break out of that in 14 days? I don't know. Paulie, I just went over that. What do we think, guys? Fixie, are we going to enter? I wouldn't enter it as a strangle with one ticket. I would buy the calls and then I would buy the puts. Yeah. So Ford, they're expecting a lot of movement, but look, it's been in such a tight range. Okay. So honestly, I don't love Ford. I don't see Ford busting out of that tight range, 885 to 1117. Not a fan. Not a fan. It's a low vol stock. Vale is another sneaky little gappy. So this is interesting. Here, let me pull this up. I'm going to put these next to each other because this is another little sneaky lesson for you guys. And the sneaky lesson is we just looked at Ford, right? And I was saying, well, I don't know if Ford can move that much. There's only 14 days left. Well, now let's look at Vale. Why is this Vale and not Vale? Because it's a Brazilian company, and I enjoy saying Vale. So Vale, and then our expensive one was Ford. Okay. Both are trading at $10, right? Vale, 1116 to 912, 1117 to 885. Ford has more uncertainty than this name Vale. Look how it gaps all over the place. Again, it's a Brazilian name, historically trades at a higher volatility than Ford. This might be something to consider. I really like Fixie better. The reason I like Fixie better is because it's so cheap. And so cheap, I mean, actually, Vale will be pretty cheap too. Vale, I mean. Jonathan Vale, Brazilian. Fun. You know what? This is a fun play. 10s for a quarter for 15 days. It's really cheap. So this is a kind of a fun trade because if it works out, you can make 4 times your money. So pretty cheap. I kind of like the upside of Vale more than the downside. If you guys have any other do technical analysis, you could look at both sides, but Vale is just cheap. Cheap. X, been incredibly volatile. And you can see just on this how volatile it is. And when you see names that are this volatile, we don't want to buy options. Right? 48 to 33, come on. That's crazy. It's just too much volatility. We don't have to do that. Nike at the bottom of its expected move. The news on Nike just continues to get worse and worse and worse. But I don't think it's a bad play. I always enjoy fading the news. Fading means to do the opposite. So here's another thing to consider as well. And again, just sharing a lot of trades because I know a lot of people are underwater in their longer term portfolios. Traders, can make back money when volatility spikes. Volatility creates opportunity. Nike, outside of its expected move right here, let's play for it to come back inside of its expected move. 66 up to $1.15. Goodbye those 66s up to $1.15. And again, just because the news is real bad, guys, trust the expected move bands, the lines a lot more than news. News is often a fade. Fading, contrarian view. That's exactly correct. If something continues to rally and you sell it, I would say that you are fading that move. Good question. By the way, that's something that I'm working on too. I would love for you guys to hold me accountable because I use terms like faded and trading terms too often. And I want to do better at stopping and explaining those. So when I do that, guys, catch me because I should be explaining those a little bit more. Nike, interesting. Toyota Motors, I like it, but I can't talk about it too much because we have an open position in Toyota Motors. And then finally, we actually have a divergence opportunity that we're going to save for our all access portion of this video. We share trades with our advanced notice, our all access, and our earnings program, and our short-term options. So let me get back on live. Say hello. Here I am. Got another question from Dimitri. No, I say it to Dimitri, thank you. And Dimitri is just saying, I like the offer term. Got really confused the first time you say it. So when the market goes offered, and just being a floor trader, offered. Literally, people do that on the floor. If people want to buy something, they'll buy it. So that's just being in Chicago, learning how to trade, coming up, trading with my hands. It's still in my vernacular. So hold me accountable on that. When I do say stuff like that, call me out. I'd love to explain it. I'd love to dig deeper into it. This was a lot of fun. 3 trades that we talked about where there are opportunity in the next 14 days. Hopefully, we're going to be able to make some money in these 14 days, and you'll let me know. For everybody in our all access, I am so excited about this next trade that's going to take advantage of the discrepancies or the divergencies caused by this increase in tariff volatility. Hope you enjoyed that. We're going to be live tomorrow, just like we're live every day, 11 a.m. Eastern Time. Thanks for watching All Access. We'll be right back, guys.